So when it comes to stocks, billionaire, in quotes, billionaire Warren Buffett offers simple advice. And I like this. I like simple advice. And he says, invest in the S&P 500 index fund. He says the group of stocks has outperformed most professional money managers for more than a decade. Yet an index fund isn't a retirement plan. So, Frankie, can you tell us the difference between having financial vehicles versus having a written plan?
Yeah, absolutely. So financial vehicles in general are a means or a part of the plan. They're not the full plan in itself. So there's investment planning, so you're going to decide which investments to choose from. In this case, our good buddy Warren Buffett's telling us to put it into the S&P 500. So that's your investment allocation. However, there's so many more things involved in a retirement plan. You have to think about, okay, well, what am I going to do for my income planning? Because if I put it all in the S&P 500, and let's say it's 2008 and the S&P 500 goes down 50%, well, now am I going to take income out of that? How is my plan for that? So there's a lot of other things that we have to take into consideration. That investment allocation doesn't necessarily help you with when to take Social Security in retirement. It doesn't help you with, how should I have my beneficiaries on my accounts placed. All of this other important stuff is involved in the retirement planning that the allocation is not part of that conversation. So there's very different positions between the financial vehicles and the written financial plan. The financial vehicles are also a very important part of that plan, and putting the money into the S&P 500 for Warren Buffett is a great idea. For him, he has billions of dollars. For him to just put it right in the index, let it ride, that would work very well for him, because he's not taking, however much he's taking out of income per year for his own spend is not going to be a significant amount of his portfolio. So because of that, if his money went down 50%, it wouldn't make a difference for his income or his lifestyle. For our clients and for the people listening, if your financial portfolio went down 50%, that could really make a difference in your retirement. So if you had $2 million saved and that went down to $1 million, or $1 million and it went down to $500,000, that can make a huge difference. So when we do our allocations, the S&P 500 index funds are a portion of it, but it's not the full entire thing. So we typically have a third of it or so, in the S&P 500 ETF type of allocations. And this is just general numbers. And then we have a third using like the fixed index annuities, which don't go down when the market goes down. And then we have about a third of it using the computer algorithms with the tactical management that shoots to get out of the market and more into cash as there's volatile times such as there are now. So that kind of investment allocation typically will help to reduce the risk as the S&P 500 is in volatile times such as now.